Hey guys, welcome back to Stacking Stocks, and many thanks for joining us today. Are you super excited to join today's session? As usual, we have more informative content for you as we talk about why smart money is buying Alibaba stock. Here's what we know. For starters, let's explore why some investors are buying into Alibaba. So in this video, we're going to try to go through what a section of top investors have said publicly to see what their thoughts are about the pros and cons of Alibaba. It's essential to have a look at such things as they'll guide our discussion today. Also, stick around at the end of the video and we'll also talk about valuation. So with that said, let's get started. Let's start by talking about China. Most of us see Alibaba and agree at a basic level that the share price seems pretty cheap for the underlying business. But the reason it's so cheap is that a lot of investors are getting nervous about China itself and whether Alibaba will continue to thrive in that system. The Chinese online shopping behemoth has been slammed in recent months by Beijing's widening crackdown on private business, stoking concerns about its future. Despite an increase in sales, we've witnessed a drop in the company's earnings. Net income of 45.1 billion yuan, or about $7 billion, slipped from 47.6 billion yuan it earned a year earlier, but its adjusted earnings were a bit better than recently lowered estimates from analysts. Alibaba's revenue of 205.7 billion yuan, or about $32 billion, while up 34% from a year ago, fell a bit short of expectations. Can you now see why investors have been nervous? The company tried to assure investors by announcing it will now repurchase $15 billion in shares through next year, up from a $10 billion repurchase plan that had been in place. It also disclosed it had repurchased $3.7 billion worth of its U.S.-traded shares since April. Does this make things any better? Are you reassured as an Alibaba stock investor? Maybe it does. Well, it all depends on what you think about this situation. But how did we get here? We know that Alibaba's main business, e-commerce, has held up well during the coronavirus pandemic, soaring as people took to online shopping to buy things without leaving their homes. The company has also benefited from continued economic strength in China, which averted the recession that pummeled most of the globe last year. So what happened to the company? Why have the earnings been dropping? We think it's because the prospect of further scrutiny from Chinese regulators looms large. Let's have a closer look at that situation. In May, Alibaba said it posted a loss of $1.2 billion for its first quarter, a hit that was mainly due to a record $2.8 billion fine that Beijing imposed on the company after accusing it of behaving like a monopoly. That was quite a hefty fine. So we've looked at the crackdown by Chinese government regulators, but does it end there? Beijing's broader clampdown hasn't let up. Alibaba's New York-listed shares plunged nearly 14% during July as investors grew nervous about Chinese tech, including the ability of such companies to trade outside of China. But we'd understand why investors get nervous with all that's been happening. We think most of China would be off limits for some investors just because they probably couldn't understand it well enough. Let's look at a business like Tencent or Alibaba. These two companies, specifically very early in their journey, had Western investors or non-Chinese investors right from the beginning. We think of them more as happening to be based in China, and because it's such a large market. They also happen to have most of their operations in China, but they're really, in many ways, multinational in their views and how they look at things. We'd say that they have had a lot of non-Chinese infusion into their DNA and thinking. And many of those elements are a big positive for them. But we still have got a lot to say about investors getting nervous about Alibaba stock. What more have we got? Regulatory scrutiny on a broadening number of industries has also spooked investors. A stock market sell-off wiped out hundreds of billions of dollars in market value for several prominent Chinese tech companies, including Alibaba. That came as Beijing issued directives for education tech, food delivery, and other sectors. We think that investors need to stay calm in order to overcome the situation. We all know that panic is a fatal disease when it comes to investments. Yes, we understand that there are serious issues affecting the company, but this is also a company with serious potential. Over 1 billion consumers use its marketplaces, including 891 million in China and 240 million abroad. Organic sales growth is 32%. It's in the early stages of rolling out its AliCloud cloud computing business, which could be the next big growth driver. Maybe as an investor, you need to relax and wait for the rise and dominion of Alibaba stock once again. We believe that Alibaba remains a fundamentally robust business as its core operating segments continue to grow at impressive rates. Despite its strong growth rates, Baba stock trades at under 3 times forward sales, making it an attractive long-term bet. Investors are seriously concerned about Alibaba's $15.5 billion in contributions to China's Common Prosperity Initiatives. It raises issues about the company's subservience to the Chinese government and the influence of the government. However, investors seem to be missing how the company is killing two birds with one stone here. There's more than meets the eye. So we've talked about Alibaba's lows. It's time to hit the highs. Here's what we know. With its contribution, the hope is that it would probably come under less scrutiny of the government and get protected from Western competition. The strategic deployment of the funds may also garner a lot of goodwill from the Chinese people. Perhaps more importantly, it's likely to increase its customer base as the contribution focuses on the deployment of digital services in underdeveloped areas. Furthermore, Alibaba has also been investing in its underlying businesses to improve sales from existing customers. The goal is to create increased customer engagement, increased purchase frequency, and offer unique value propositions. What do you think about this strategy? From how we see it, it's the smartest thing Alibaba could have chosen to do amidst severe government scrutiny. Despite all this, the company's fundamentals have actually remained very strong. Alibaba suffered multiple setbacks in the past year, but its core businesses continue to deliver. In fiscal 2021, its revenue shot up 41% to $109.5 million, and its adjusted net income, excluding the antitrust fine, rose 30% to $26.3 billion. Core commerce revenues also increased 42%, along with a 50% increase in cloud computing revenues. Analysts are expecting revenue to rise 29% this year for Alibaba. On the flip side, the consensus is that adjusted EPS will take a substantial hit of 26% as the companies rely more on lower margin retail businesses during the year and make several new investments. However, analysts expect revenues and adjusted EPS to rise 21% and 15% respectively next year. Based on these estimates, Baba stock still trades below 3 times forward sales. So much for a company many investors thought was on a losing earnings trajectory. The company still manages to prove investors wrong with its superb results. Don't you think so? Do you know that Alibaba's domestic retail business still accounts for more than 65% of its total sales? However, its other businesses, including international retail, logistics, and cloud computing sales, are also expanding at an impressive pace. Hence, there's plenty of room for the company to grow even more thanks to its non-core businesses. Baba stock has taken a considerable beating in the past year on the back of its regulatory challenges, but it's a fundamentally solid business that continues to perform incredibly well across all its segments. Additionally, its recent investments will reduce its regulatory risks and expand its total addressable market in the future. Therefore, Baba stock remains a top play in the e-commerce realm. Well, the choice to keep the Alibaba stock is yours to make. Alibaba's relative strength line is starting to point upward after a long period of underperformance. We believe that there are better days ahead for the Chinese stock. We'll keep you updated. Once again, thank you for tuning in today. Remember to like, share, and subscribe. See you next time right here on Stacking Stocks.